Greetings and welcome to the latest edition of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their owners redomesticate out of volatile legal and tax environments to predictable pro entrepreneurship, pro growth jurisdictions like Florida and Texas. Today, we are reviewing a recent report by Julie Taylor writing for Realtor.com entitled Mapped: How Much You Need to Earn to Be Considered Middle Class by State. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications covering accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. Visual Capitalist and Realtor.com just published a state by state breakdown of the income required to qualify as middle class in every state using data from Smart Asset, the U.S. Census Bureau, and the Pew Research Center. The Pew Research Center defines the lower bound of middle income as 2/3 of the median income. The results vary by tens of thousands of dollars depending upon where you live. Massachusetts ranks first, or I should say last, as that will make more sense in a few moments. A household in Massachusetts must earn roughly $70,000 per year to even begin to enter the middle income range. Similarly, and not far off that mark, New Jersey follows at 69,500, Maryland at 68,600, California at 66,800, though many Californians will tell you that is probably closer to the poverty line, especially in certain counties. Meanwhile, New Hampshire is at 66,500, Washington State at 66,300, Colorado at 64,700. I think you get the idea. Now, let's move a little further down the list. Florida requires 51,800. Texas is at 53,100. The spread between the most expensive and least expensive states is over $30,000 per year. That's a car. That is $30,000 in income a household must earn before it even qualifies as middle class. Not wealthy, not upper class, but just getting by. Now, the article makes the housing connection explicit. Massachusetts has a median listing price of, 716,000. I was going to say 16,000. That's way too low. $716,225. New Jersey's a little bit lower, but still an eye-watering $529,000. Maryland, $400K. A senior economic research analyst at Realtor.com noted that in the top 3 states, a middle class income would be able to afford a home price between about $315,000 and $320,000, assuming a 6.11% mortgage rate and a 10% down payment. The median listing price in those states are 2 to 3 times what a middle class buyer could potentially afford. A real estate professional in Massachusetts told Realtor.com that the biggest obstacle for buyers is not qualifying for a mortgage, but saving for a down payment whilst keeping up with the expanding and rising cost of living. He said that more people are staying in rentals longer, buying farther from the city, or relying on family support to enter the market. In New Jersey and Maryland, housing costs have increased by more than 30% over the last 5 years, and salaries have not kept pace. In those states, individuals earning middle class salaries are struggling with property taxes and other expenses on top of already unaffordable housing. Now, this data tell a business owner something that the headline does not. The states where it costs the most to be able to be considered middle class are the same states imposing the highest taxes on business owners who operate through pass-through entities. Massachusetts, New Jersey, Maryland, California, New York, and Illinois all appear at the top of this list. And remember, that is not a good thing. This is the Hall of Shame, not the Hall of Fame. They also appear at the top of every list measuring a tax burden, regulatory cost, and outbound migration. Massachusetts charges a flat 5% income tax plus a 4% surtax on income above $1 million. New Jersey's top state marginal tax rate is almost 11%. Maryland layers a state rate above 5.75% with county income tax surcharges that push the effective rate above 8% for many residents. California charges 13.3%. Actually, it's higher when you factor in the payroll tax. Meanwhile, New York charges almost 11% and higher if you are in New York City, of course. In every one of those states, pass-through business income flows through to the owner's personal return and gets taxed at those rates based upon the jurisdiction from which the income is sourced. To put that in perspective, a business owner in New Jersey earning $500,000 on New Jersey pass-through income is paying over $50,000 per year in state income tax and then paying property taxes that rank among the highest in the nation at almost $10,000 per year at the median, then paying for housing that costs $529,000 at the median listing price, then earning an income that barely qualifies as middle class in that state. That is not a winning combination for the long term. Meanwhile, down south, Florida requires $51,800 to be in the middle class, and Texas is even, well, I shouldn't say lower, it's about the same at $53,100. Neither Florida nor Texas impose a personal income tax. Florida's median property tax bill is $3,000. Texas is slightly higher at $4,108. The Texas Constitution, in fact, prohibits the state legislature from ever imposing a personal income tax. A business owner who moves from Jersey to Florida also eliminates the state income tax entirely on Florida-sourced income, reduces their property tax bill by over $6,000 per year at the median, and enters a state where the middle class is actually attainable. That same business owner's income goes further in every measurable category: housing, taxes, utilities, groceries, fuel, and cost of living. The money does not disappear. Rather, it stays in the business, or even better, in the owner's pocket. For any business owner in one of these high cost, high tax states who has decided that the math simply no longer works, the question is not whether to move, but how to move the company without losing its existing federal employer identification number, contracts, credit history, vendor relationships, customer relationships, or bank accounts. And the answer in many cases is redomestication. Now, redomestication is the lesser known legal process of transferring a company's state of domicile from one jurisdiction to another. It is not enough for the owner to simply move. Changing personal domicile does not change the company domicile. And while those are related concepts, they are legally distinct. Under a successful redomestication, the company that exists after the redomestication is the same legal entity that existed before. No new entity is created. No dissolution occurs. Those are two very important points. And when performed by a competent attorney in strict compliance with the Federal Internal Revenue Code, applicable Treasury regulations, and the statutes of both the departing and destination states, redomestication is tax-free at both the entity and owner levels. The so-called alternatives are really not alternatives at all. Let's start with foreign entity registration, also referred to as foreign qualification. Foreign entity registration merely keeps the company domiciled in the old state, which means continued tax and legal exposure in the old state and dual compliance burdens that defeat the purpose of leaving. Foreign qualification is not a mechanism for relocating a company, and yet, surprisingly, CPAs and even many attorneys. So I'm so excited about this topic, I can barely talk. Even many attorneys seem to recommend foreign qualification for reasons that are not clear. We will generously chalk that up to them being underinformed or out of the loop, so to speak, on latest developments. Now, it is true, historically, many states did not permit redomestication, but in 2026 and beyond, that is no longer the case. Now, in certain cases, we still may use a traditional merger, but for the most part, that is no longer necessary. A traditional merger requires forming a new entity in the destination state, transferring assets, which can be a taxable event, renegotiating contracts, and navigating federal tax complexity that can convert what should have been a relatively simple process into a taxable event if even a single step is missed. Finally, dissolution. Now, dissolution is the death penalty. Dissolution kills the company, eliminates the liability shield, exposes personal assets of the owners jointly and severally to creditors, both known and unknown, past, present, and future, and triggers tax consequences in many cases at both the state and federal levels. Think about that. If you are hearing dissolution being suggested as a mechanism for relocation, run, do not walk, but run out the door and seek a second opinion. Dissolution, I like to say, is the equivalent of burning down your house to move to a new neighborhood, and therefore it should not enter the conversation unless the company is truly ceasing operations. Now, if you have questions regarding redomesticating your existing limited liability company or corporation, please use the link in the description for more information on this process and to schedule time for you and I to speak about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information useful. As always, the information in this presentation is general in nature, and it is not legal advice, because legal advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier presentations on these timely topics, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. I look forward to that opportunity to speak with and perhaps even work with you very soon.